Have you felt a creeping dread about the future of the dollar? Threatening warnings suggest our currency teeters on the brink as America's debts balloon to unfathomable heights. But how could a dollar collapse impact you? Mortgages, credit cards, car loans. No debt may be spared if the dollar plunges into devaluation. The U.S. national debt is surging to unimaginable heights, and economists are warning of potential currency devaluation.
Any currency that is pegged to gold is going to be a superior currency to the US dollar, which is pegged to nothing.
This could significantly impact your debt, making it more difficult to repay. With insight and preparation, average Americans can stay afloat when the dollar drowns in devaluation.
Would a U.S. dollar change your mind?
The time is now to learn to navigate the financial storms ahead. Sweeping across the grand theater of history, currencies have risen and fallen with empires. From the once mighty Roman denarii to the sterling's reign during Britain's colonial dominion, a global currency system has always served as a reflection of power dynamics. The US dollar now dominates this stage, prestige preserved by the faith in its economic stability and reliability for international trade. Yet, as history reveals, no supremacy lasts forever. The ongoing discussions about potential threats to the dollar hegemony suggest that even America's robust financial empire could waver under high inflationary pressures or buckling international debt burdens, scenarios uncomfortably familiar from past currency collapses. Such possible threats forecast not only shifts in geopolitical factors and financial markets, but also caution us on how changes in reserve currency status might directly impact our asset value and personal debts. Financial gurus and economic enthusiasts alike have taken notice of worrisome signals suggesting the possible collapse of the dollar. These ominous indications include a soaring U.S. debt crisis, brought about by years of over-reliance on borrowed money, and the gradual decline in global currency status faced by the American dollar. As per expert predictions, such a catastrophic event might not be imminent or even occur within this decade. Still, it's crucial to analyze these subtle signs with eagle-eyed vigilance. While absolute certainty remains elusive in financial forecasting, historical patterns offer valuable guidance for anticipating potential outcomes. Parallels can be drawn from past empires that experienced similar conditions. Sky-high national debts exceeding their economy's size, followed by an asset flight-induced economic downturn. The bright side is that despite these challenges facing our modern-day empire, the United States, most experts are confident in its robustness and resilience against bankruptcy, a testament to America's inherent ability to bounce back even from cliff-edge scenarios. Historical lessons hold the key to understanding our current economic conditions regarding the collapse of empires and its impact on debt. From the eerie silence that followed Rome's fall, we learned how an empire's decline can trigger massive economic turmoil. Economist Albert Edwards has highlighted how central bank quantitative easing is creating catastrophic distortions in today's economy, a warning echoed by many financial historians. The Great Depression is a glaring example of a past disaster that serves as a grim reminder for us all. It was during this period when farmers, unable to service their debts, were thrown into jail and their farms confiscated, a crisis so profound it spurred changes to the U.S. Constitution. This unprecedented global shockwave underscores the dire consequences of failing economies and rampant debt, reiterating why wisdom from these historical events should not be overlooked in any conversation about possible dollar collapse. Mortgages are a fundamental aspect of the debt landscape that individuals navigate when considering homeownership. While they offer stability and a sense of accomplishment, mortgages can also be demanding in terms of financial commitment. With rising household debt, it's important to understand the potential impact of a dollar collapse on these obligations. Factors such as currency exchange rates and economic growth indicators play a crucial role in determining the affordability and sustainability of mortgage payments. Additionally, changes in interest rates resulting from a currency spiral could significantly affect homeowners' ability to keep up with their mortgage obligations.
Home buyers across the country have been feeling the pinch when it comes to rising mortgage rates. The average 30-year mortgage is approaching 7%. That's nearly 2 points higher than a year ago, and it's more than double from 2 years ago during the low point of the pandemic.
As borrowers manage their finances amidst uncertain times, prudence and careful consideration become paramount to weathering any storm that may come their way. Credit cards, with their shiny rewards and convenient swipe-and-go capabilities, can be incredibly tempting. However, beneath their alluring exterior lies a treacherous trap that many fall into: credit card debt. The ease of swiping a piece of plastic often leads to overspending and accumulating high-interest debt that can quickly spiral out of control. This type of debt crisis has far-reaching consequences on individuals and the global economy. One alarming effect of credit card debt is its ability to cause financial crises, impacting not only personal finances, but also the housing market. When consumers struggle to repay their credit card debts, they may find themselves unable to meet mortgage payments as well. This decline in homeowners' ability to make timely payments can lead to declining home prices, and even a collapse in the value of housing-related assets.
Cheap, cheap, cheap.
Furthermore, the ripple effects of credit card debt are felt beyond individual households. Unemployment rates tend to rise during such crises. As people struggle with mounting debts and dwindling resources, businesses may suffer from reduced consumer spending power power and cutbacks in production or services. A chain reaction occurs as job losses increase across different sectors due to economic downturns caused by heavy reliance on credit. Car loans can be a double-edged sword for many Americans. On one hand, they offer an affordable way to purchase a much-needed vehicle. On the other hand, these loans can quickly become inflexible and burdensome.
In order to buy a car, on average, Americans will borrow $39,000 for a new car, $27,000 for a used car. These loans, of course, generate interest.
With rising car prices and household debt levels reaching unprecedented heights, borrowers are finding themselves owing thousands of dollars on their auto loans. The allure of low monthly payments may seem enticing at first, but the reality is that these loans come with high interest rates and rigid repayment terms. This has led to more individuals defaulting on their car loans as financial difficulties arise. As we navigate through uncertain economic times, it's crucial to consider the implications of mounting car loan debt and explore alternatives that offer greater flexibility and financial security. As the fate of the US dollar hangs precariously in the balance, debt obligations stand to unravel amidst impending financial chaos. The collapse of a currency can have far-reaching consequences for individuals and businesses alike, with debt repayment becoming an increasingly daunting task. With interest rates soaring in tandem with spiraling currencies, the affordability of loans becomes questionable at best. As economic instability looms and global trade trembles on uncertain ground, it is crucial to consider the implications this could have on debt obligations. The potential for currency devaluation puts borrowers at risk of facing increased costs when paying down debt denominated in a collapsing currency. In times like these, it becomes ever more essential for individuals and businesses to ensure their financial stability as they navigate through stormy waters. Rising interest rates can send shockwaves through the financial markets, causing currencies to spiral downward. This phenomenon is currently a cause for concern among economic enthusiasts as they closely monitor the potential impact on their investments and debt obligations. With interest rates on the rise, borrowers may find themselves facing higher repayment costs and increased financial strain. The Federal Reserve's decision to increase interest rates has resulted in a stronger US dollar, highlighting its centrality to the global economy. Furthermore, anticipation of further rate hikes by the Federal Reserve is putting additional downward pressure on Asian currencies. While increasing interest rates theoretically lead to currency depreciation, this outcome does not always come to pass in reality. As the global economy becomes increasingly interconnected, the possibility of the dollar's collapse raises concerns about what would happen in such a scenario. It's important to note that imagining the end is not meant to sow fear or panic, but rather to understand the potential ramifications and prepare accordingly. A currency collapse can lead to economic instability, market fluctuations, and even a global financial crisis. However, it's worth considering safe haven investments like gold, silver, real estate, undervalued stocks, and cryptocurrencies like Bitcoin that have historically offered some protection during times of currency turmoil. While no one knows exactly how or when this could happen, it is wise for individuals to adjust their financial sales by diversifying their asset allocation and staying informed about current economic trends. Gold, silver, and other commodities are seen as safe havens during financial turmoil and currency devaluation. As the dollar teeters on the edge of collapse, these tangible assets are starting to shine brighter than ever before. Why? Because precious metals like gold and silver have proven to be resilient in the face of economic downturns. When there is increased market demand for precious metals, their prices tend to rise. Unlike paper currency that can be easily manipulated or devalued by governments, gold and silver hold intrinsic value. While investing in gold is not without risk, it can provide a certain level of security during an economic collapse. The strength or weakness of the US dollar often influences the value of commodities like gold and silver. If the dollar collapses, these precious metals could potentially skyrocket in value. Real estate, undervalued stocks, and Bitcoin are investment options that can provide hope for those looking to navigate the uncertain waters of a potential dollar collapse. Real estate remains a tangible asset that can provide stability in times of financial turmoil. High net worth investors can explore opportunities to acquire undervalued properties and generate long-term income through rental properties or capital appreciation when market conditions improve. Undervalued stocks may be overlooked or undervalued in times of market instability. By conducting thorough research and identifying companies with strong fundamentals and growth potential, investors can position themselves to benefit from potential market rebounds and capitalize on future opportunities. Bitcoin is a decentralized cryptocurrency with a limited supply. It has gained popularity as a hedge against traditional fiat currencies.
I turned $350 into $12,000.
He says that $12,000 turned to six figures in a year. He became a millionaire at 24. All by investing in Bitcoin.
Some prominent investors, such as Robert Kiyosaki, advise considering Bitcoin as a safe haven asset amid concerns over a potential real estate market crash. Throughout history, empires rise and fall, currencies come and go, and the tides of economic power constantly shift. It is an inevitable cycle that has repeated itself time and again. From the collapse of world commodity prices in the 1837 panic to the burst of the housing bubble in our modern era, financial crises have left their mark on our collective history. In the face of a potential dollar collapse, every American American must be prepared to adjust their financial strategies for the winds of change. This means diversifying assets and exploring alternative investment options that can weather the storm. While it's impossible to predict exactly what will happen if the dollar does collapse, history has taught us that being proactive is crucial in times of uncertainty. The global trade landscape could undergo a significant reconfiguration, resulting in shifts in foreign exchange rates and government regulations. By staying abreast of future trends analysis and considering currency diversification strategies, individuals can position themselves more prudently for whatever lies ahead. In this paradigm shift, those who adapt will most likely thrive amidst societal decline and market instability. So what does the future hold for the US dollar? Will it continue to be the world's reserve currency, or will it collapse? Only time will tell. But one thing is for sure, those who are prepared for the possibility of a dollar collapse will be in a much better position to weather the storm. As history has taught us, empires rise and fall, and currencies can crumble. The future of the US dollar is uncertain, but by being prepared, you can take control of your financial future. So, what are you waiting for? Start planning today. But before you go, I'm curious, what do you think the future holds for the US dollar? Will it continue to be the world's reserve currency, or will it collapse? Leave your thoughts in the comments below. And if you are ever wondered about why millennials and Gen Z quietly gave up work, make sure to check out my recent video.